You walk into a bank. Same clothes, same confidence, same income on paper. Two people make the same request. One walks out approved. The other walks out quietly rejected. No one explains why. There's no argument, no visible rule broken. Just a number. An invisible score that follows you everywhere and decides how much your life will cost. And here's the uncomfortable part. That number might matter more than how much you actually earn. Right now, access to money isn't just about money, it's about permission. Permission to borrow, to invest, to move forward faster than time would normally allow. And that permission is controlled by a system that looks neutral. It looks like data, but it behaves like power. Because this score isn't just measuring you, it's predicting you, and then pricing your future based on that prediction. Here's how it actually works. Every time you interact with the financial system, using a credit card, paying a bill, missing a payment, taking a loan, you leave behind a trail. Not a story, not context, just signals. Those signals get compressed into a single number, a credit score. Simple enough on the surface. Pay on time, score goes up. Miss payments, score goes down. But that's only the visible layer. Underneath, the system is asking a different question. How predictable are you as a source of profit? Because from the lender's perspective, you are not just a person, you're a risk profile, a probability, a future stream of payments. And the goal isn't to help you succeed. The goal is to price that risk correctly. Too risky? You get denied. Safe enough? You get approved, but at a higher cost. Very safe? You get the best rates and the cheapest access to capital, which creates a strange loop. The people who need money the most pay the highest price for it, and the people who need it the least get it almost for free. Now pause for a second, because this is where it gets uncomfortable. Your score doesn't just reflect your past, it shapes your future. A lower score means higher interest rates. Higher interest rates mean more expensive debt. More expensive debt makes it harder to save, invest, or recover, which increases the chance of future financial stress, which lowers your score again. It's not just a measurement, it's a feedback loop. And once you're inside it, climbing out becomes mathematically harder. Meanwhile, someone with a high score borrows cheaply. They invest earlier. They take more calculated risks. They recover faster from mistakes. Not because they're smarter, but because the system is cheaper for them. Same economy, different rules.
And here's the irony. Publicly, we talk about merit, work hard, earn more, build wealth. But quietly, in the background, there's a second system running. One that decides how expensive your progress will be, and it rarely gets discussed. Now take a wider view. This isn't just about individuals. This logic scales. Entire communities, even countries, can fall into similar patterns. Higher perceived risk leads to higher borrowing costs. Higher costs, slow growth. Slower growth reinforces the perception of risk. The loop repeats. So what looks like bad financial behavior is sometimes just expensive access to money. And expensive access to money is often a starting condition, not a personal failure. But the system doesn't see starting conditions, it sees data. Clean, simplified, context removed. There's also something else happening beneath the surface. The score rewards stability, consistency, predictability, routine, which sounds reasonable until you realize that real life isn't stable. People lose jobs, get sick, move cities, start businesses, and the moment you step outside predictable patterns, your score can drop, even if the decision makes sense long term. So the system quietly encourages one thing: don't deviate, don't take too many risks, don't break the pattern. In a world that constantly tells you to take risks and think big, it's a subtle contradiction. Now zoom out even further, because we're moving into a future where this idea of scoring expands beyond credit into behavior, spending patterns, digital footprints, more data, better predictions, more accurate pricing of risk, which sounds efficient, but also raises a question. At what point does prediction start to limit possibility? If your past behavior defines your access to the future, how much room is left to change? And who decides when you've changed enough? The invisible score was supposed to make lending safer, more rational, more fair. And in many ways, it did, but it also created a system where access to opportunity is pre-filtered, quietly, automatically, at scale. So the next time two people walk into a bank and only one walks out with approval, it's not just about income or effort or even responsibility. It's about how a system sees them, not as they are, but as it expects them to be. And that leaves a question hanging. If your financial future is being priced by a prediction, how do you ever become something the system didn't expect?